Okay, good afternoon, everybody, and thank you for joining this InvestEngine webinar in partnership with Xtrackers. So for those of you who haven't tuned into one of these webinars before, my name is Andy Prosser. I'm the Head of Investments at InvestEngine, and I am delighted today to be joined by Haneen Sakhi, who is an ETF Product Specialist at Xtrackers. Now, in terms of the plan for today's webinar, it's going to be a bit of a Q&A. So I've got a few questions, which I think that people will likely want to know the answers to. And we're going to start off with some of those. But I'm also going to be picking questions from the Q&A as well at the end. So if you do want to ask questions as we're going through the webinar, you can click on the Q&A button in the bottom of the screen. The questions aren't going to be broadcast to the whole chat. They're just going to come straight to us. So don't worry if you think you've got a stupid question. That's absolutely fine. Feel free to ask away and we will answer as many as we can at the end. I should say that this is being recorded. We always get lots of questions about whether it's being recorded and when it's being uploaded to YouTube. It will be uploaded to YouTube in the coming days. So don't worry if you can only make part of the webinar and you have to drop off halfway through. That's totally fine. You can always re-watch it later. Now, it's my job to make sure that everything runs on time. So I need to make sure I leave enough time at the end, probably no more than 5 minutes or so, for a quick demo of how to buy this ETF that we're going to be talking about today on our InvestEngine platform. So I'm hoping that once we've wrapped everything up, we'll be ending the webinar at about 5:40, 5:45, something like that. So before we get stuck into overnight rate ETFs, I do need to mention one quick thing, which is the usual disclaimer that your capital is at risk whenever you invest, that this webinar is for UK clients only, and that none of this is financial advice. So without further ado, let's get going with the first question. So Haneen, can you please start off by just giving us a bit of an introduction to what overnight rate ETFs are and who is SONIA?
Thank you, Andy. So of course, I mean, if we look at overnight rates, they are an integral part of our financial system. So typically each major currency area has its own benchmark overnight rate. In the UK, we have SONIA. So SONIA stands for the Sterling Overnight Index Average. And essentially, overnight rates are benchmark rates that reflect the average interest that banks pay to borrow money from each other or other financial institutions overnight, so in the overnight market. And for us in the UK, this rate is set and published daily by the Bank of England, making it a very key short-term money market reference for the sterling market specifically. So SONIA is calculated using real transactions, not estimates. Each morning, the Bank of England collects data from banks, checks it for accuracy, and then publishes the average rate. And because it's based on actual trades, SONIA gives a true picture of the market. So three key reasons why SONIA is important, or three key features of SONIA. If you look at the boxes at the bottom of the slide. So first thing is that it's transaction-based, as I mentioned, so reflecting real economic activity, making it less volatile more generally. It's liquid, so it has a deep and liquid underlying, typically with over 40 to 60 billion traded daily. And it's also a near risk-free rate. And it doesn't carry the same risk as longer term or riskier loans. So it has does not contain material term risk because it's an overnight rate or any bank credit risk. And so why might you as an investor want to gain access to an overnight rate? If we jump to the next slide. Well, that's because the rate pretty much moves in line with the Bank of England base rate, but slightly lower. So if we're looking at the graph on the slide here, the SONIA rate is the orange line and the base rate, the Bank of England base rate, is the grey line. You can see very much moves in line, but again, slightly lower here. But how can you access the overnight rate? Well, an ETF does a pretty good job at allowing you to access this rate. So one of the biggest advantages of overnight rate ETFs is that they let you benefit directly from changes in SONIA as it aims to provide exposure to that rate. So as the Bank of England raises or lowers its rate, SONIA moves too, and so do the returns that you can earn from holding an overnight rate ETFs. So what does it look like? If you can see the blue line here on the graph here that I haven't mentioned just yet, this is the index performance, which you get via the ETF. Through its synthetic replication process, and this is essentially compounded daily. So it reflects the performance of an investment earning interest on the SONIA overnight rate, and it's compounded on a daily basis. So each day's SONIA rate is applied to the previous day's index level. So its interest effectively earns interest over time. You may notice one thing is that the curve is upward sloping. And that's because as long as rates are positive, your returns will continue to grow. The only way in which the returns will, or the curve will be downward sloping is if the rates become negative. But we've never had negative rates, and it's very unlikely that we'll have negative rates. One thing that does change, actually, when the Bank of England rate or SONIA rate changes, is the slope of the curve. So the level of returns and the level of growth that you can get. So if you look at towards the left-hand side of this chart around 2022, where we had these various interest rate hikes in the UK, the curve began to steepen. So the level of returns you received began to became higher because the rates were higher. And the same thing happens when rates go down, the curve becomes shallower. So effectively, the ETF yields the current overnight rate minus the TER of the fund, so the all-in fee of the fund.
Perfect. Thank you very much. That's a really helpful intro just to kind of set the scene. Now, one of the things that is on the top of everybody's minds at the moment is the autumn budget, which is next week, obviously. So could you explain a little bit about why these types of ETFs are particularly relevant with this budget coming up, especially maybe given some of the potential changes to the ISA rules?
Of course. So, I mean, leading up to the budget, there's always going to be a lot of speculation around what the budget may entail. And the outcomes of the budget can have some implication for individual investors from a saving and a portfolio allocation perspective. And as you mentioned, overnight rate ETFs can be beneficial and can help in times like these. So the way I've kind of split this up is into three buckets, because we can look at the impacts of the budget in terms of immediate terms, more medium terms, and then longer term impacts. I mean, the overriding worry when it comes to the budget is that the government faces a large fiscal gap. So this is driven by higher borrowing costs and weaker growth. So in terms of like the speculations all around that and what can happen. But in the immediate term, what's key is investor confidence, actually. And the reason why it's important is because it has a direct impact on UK borrowing costs, so long-term gilts, which is the interest the government pays on its debt, as well as the value of the pound, so the FX market. And what you'll see is that when confidence falls, investors demand higher returns for holding gilts, which pushes yields up. So higher yields means that government pays more interest, and current gilt holders see reduced returns, given that yields and prices are inversely related. And why that matters now, I mean, if we've looked at what's happening in the gilt market so far, we've basically seen a series of sell-offs, which is a direct reflection of investor confidence showing some strain in the UK. And when I say investor confidence, this isn't just UK investor confidence, this also relates to international investor confidence as well. And this is due to investor sentiment around the idea that there is too much borrowing and that government policy is heading in the wrong direction potentially. So gilt investors are getting increasingly nervous about how much more government needs to borrow in order to fund its day-to-day spending, essentially. And more recently, for example, on Friday, we saw a large sell-off, which was predominantly driven by the revised expectations on income tax after Reeves indicated that no changes were necessarily needed due to the improved forecasts that they've seen. Hence the recent market reaction, but we've already seen the gilt market recover now. So why do overnight ETFs matter in this case? So in general, as I mentioned at the start, SONIA is much less volatile. Speculations and extreme movements like this don't have a huge impact. So holding overnight rate ETFs can help shield against some of these movements, particularly if you're a gilt investor. And then again, in the immediate term, and as a result of uncertainty and volatility, some investors may take a wait and see approach until things settle. So holding cash, and as we will talk about in detail in this webinar, is that overnight rate ETFs are a good alternative to cash more generally. Now, you mentioned ISA changes and potential ISA changes. So this has a more of a medium-term impact. You won't see the impact immediately, but essentially there's been some discussions around potential ISA changes, especially around cash ISAs. So there is speculation that there will be changes on the cash ISA limit specifically. And this is because following the spring statement where Reeves confirmed that there might be a thorough review of ISAs and they'll look at the system to see whether the system is getting it right, getting the right balance between the stocks and shares ISA and cash ISAs. And currently what we see is about 2/3 of ISA limits actually sits in cash ISAs. So if they were to change the limits on cash ISAs, then this will have a huge impact on investors in terms of how they save and how they hold cash and how they invest. And of course, overnight rate ETFs are a good cash alternative and can actually be held in your stocks and shares ISA. So if they do change that limit, then they could be a potentially good option. And then more generally, if we're looking at long-term impacts, the budget does have and can influence the outlook for growth and inflation. It also affects how the Bank of England sets interest rates in the future, so whether they cut rates or increase rates. If we look at where policies are likely to be positioned in the upcoming budget, these are widely expected to be disinflationary because of where inflation is at the moment. And this is a reflection of the government's commitment to reduce inflationary pressure and to bring inflation back down towards the Bank of England's 2% target. So this can have an impact in terms of the type of taxes, for example, that the Chancellor may implement in the budget next week. I mean, in terms of inflation, we've already seen the first drop this month. So inflation is at 3.6%. This is the first drop since March at 3.8%. And inflation forecasts are expected to decrease as well if we look at it more generally. So we'll have to see what happens after the budget for this. And then if we look at the interest rate environment as well, so the current drop in inflation is keeping markets optimistic that there will be a potential cut before Christmas, and the market is pricing about 80% chance of this, a chance that this will happen, and expecting also some further cuts, potentially 2 cuts going into the next year. So a disinflationary autumn budget makes rate cuts more likely and sooner, while an inflationary budget would push them back up. So it all depends on what can happen and the outcomes of the budget next week. I mean, just to see how powerful these effects can be, let's look back at what happened after the September 2022 budget in the next slide. So I just put a little case study just to illustrate like how important the immediate impacts are, particularly for the gilt market and for government borrowing. So if we look back in 2022, so this was before the mini budget, we're looking at the 30-year yields. So that is the orange line here. And then we also have the value of the pound, so GBP USD spot rate in blue, which is your right-hand side axis. So what you see is that before the mini budget, so early 2022, yields were relatively stable, reflecting normal borrowing costs and investor confidence. And then leading up to 2022, yields started to gradually rise as concerns around fiscal policy and borrowing increased. And then sharply after the budget, you can see how there was a sharp spike in the gilt yields, jumping from about 3.5 to nearly 5% immediately. And you also had a sharp drop in the sterling USD spot, meaning sterling weakened. So this is just a reflection of how investor confidence triggered by a mini budget causing borrowing costs to surge can have immediate impacts, and looking at cash alternatives or overnight rates could really shield against those potential movements. And just to say as well that this is just an extract from the past. This is not to say that we're in a Liz Truss situation and gilts are actually well below their heights from the start of the year. And there have been a series of sell-offs. Yes, for example, the Friday one I mentioned, but they've already recovered since then.
Thank you very much. I really hope that this budget goes smoother than that infamous Liz Truss one. So you've done a really good job painting the picture of why it's kind of relevant for investors in view of the upcoming budget. We did get one question in chat just as we were going through that, asking, just kind of clarifying whether you could hold this type of ETF in an investment ISA, so stocks and shares ISA. And I think that was kind of the middle pillar of your previous slide, right? Basically just saying that, yes, although the cash ISA limits might be cut, an overnight rate ETF can be held in a stocks and shares ISA. So if you want to contribute more in cash and have that all the gains accrue tax-free, and you're probably going to exceed that limit, whatever that might be. I think at the moment the rumor is about £12,000. Then holding an overnight rate ETF in a stocks and shares ISA is absolutely a possible solution for you. Just moving away from the budget a little bit and speaking more generally, could you maybe talk a little bit about why we're hearing more and more about these overnight rate ETFs and why they're so popular at the moment?
Of course. So, I mean, there's various reasons why investors are looking towards overnight rate ETFs, and there's various ways that you can use them in your portfolio or in your ISA as well. But I mean, just to start off, if we're looking at it, following on from the gilt discussion that we were talking about from a fixed income perspective, so many investors will be holding gilts or being invested in the fixed income market, more specifically the gilts market, then SONIA actually offers a very competitive rate. And you can see this on the next slide as well. So what I've plotted on this slide and this graph here is the orange line is the yield curve for the UK government gilts, which shows the yield on the y-axis and the various maturities, so the duration on the x-axis. And this is typically what it looks like when in terms of the curve and the shape of the curve. You'd expect higher yields, i.e. higher returns, for longer maturities, given there is greater risk as you expect to hold these for longer, versus lower yields for the shorter maturities towards the left. And I've also plotted the SONIA rate here, which is around 4% right now. And what you clearly see is that it's extremely competitive versus the shorter and medium maturities that you can get from the gilt market. So it's a good alternative in terms of looking at generating income, particularly on the shorter maturity. And given what I've already explained around immediate impacts of the budget, gilts have experienced a series of sell-offs and can have immediate impact depending on investor confidence, then overnight rates may actually be a good alternative without sacrificing too much yield, particularly on that shorter medium-term maturities, without taking on the additional risk that you would get from holding the longer maturities. And then if you're looking at it from an equity investor perspective as well, on the next slide, what you also see is that equity is relatively expensive and has been quite volatile. Something important for investors to consider, and what we look at to measure how expensive stocks are, well, one way to look at how expensive stocks are is to look at the extra returns you can get from stocks compared to safer investments such as government bonds. And this is what we call the equity risk premium. And that's what's exactly plotted on this chart on the slide here. So you can see quite clearly that the equity risk premium has been drifting more recently from around 2022 and now is actually below zero. And you can quite clearly see that this is very rare for the equity risk premium to drop below zero. The last time we saw this on this chart is in 2001. So in simple terms, stocks are looking very expensive compared to bonds. And the reward for taking on more risk just isn't what it used to be. And it signals that investors are not being compensated for equity risk and from holding equity as much, making bonds more attractive. But as I mentioned in the last slide, alternative assets and overnight rate ETFs are also looking relatively attractive versus gilts. So looking at that could be a potential option, and why investors are looking more and more towards overnight rate, and particularly from an income generating perspective. For many people, this makes cash solutions even more attractive, especially if you want to avoid the ups and downs of the stock market and the volatility that we've been seeing. If we jump 2 slides, just one point I wanted to touch on here. So the final point is that how the overall interest rate environment has changed and why that matters for your cash specifically. So the rate environment has changed quite drastically over the past couple of years, as we all know, given rates were near zero for a very long time. You can see this on the left-hand chart on the slide here. And while rates are expected to go down and have been coming down, as I mentioned, we're expecting some cuts potentially by the end of this year, it is unlikely that they will return near zero soon. to where we were. We're in a very different interest rate environment, and this has implications for asset allocation and for saving rates specifically. But what does this mean for you? It means overnight rate ETFs are now offering much better yields than they did in the past, without needing to lock your money away, which is key, because ETFs are very accessible and easily accessible, or take on any of the extra equity or credit risk as you would in equity, or if you're looking at the fixed income market. And in today's environment, generally, they're just a smart way to keep your cash working for you. And on the right hand side as well, what you clearly see is that the blue line is much lower. What the blue line is the rate that you can get from an instant access deposit, so just your standard savings account in your current account, versus what you can get if you look at the SONIA rate in orange, versus also your fixed rate cash ISA deposit in gray. Yes, the gray line and the orange line are fairly aligned right now, both offering around like 4%. But most importantly, as I mentioned, you're not fixed in for a year as you would be in a 1-year fixed cash ISA deposit versus an overnight rate ETF that allows you to access much easily. And this is particularly important point if there are changes made on the cash ISA limits as well, to note that looking at overnight rate ETFs are a good alternative for saving and for income generating.
Yeah, thank you. I think that right-hand chart there is super, super powerful, right? I think one of the reasons that I like overnight rate ETFs so much is that they're comparable to your 1-year fixed rate cash ISA rates. But there's no limits to how much you can invest. A lot of these places say you can get a really good interest rate, but only if you lock away a limit of, $3,000 or $5,000 or whatever it is. There's no limit as to how much you can invest in an overnight rate ETF. Now, assuming that you're not going above your tax limits on your ISA or your SIPP. There's also no withdrawal restrictions. You can buy and sell anytime it's an ETF, so it's nice and liquid. But for me, the best bit is you don't need to constantly monitor which 1-year fixed rates or instant access accounts are the best. You just kind of set and forget, stick it in an overnight rate ETF, and you're going to be getting one of the best rates on the market at all times because it tracks SONIA. So it's a really nice kind of set and forget cash option. And one way, just kind of anecdotally, speaking from my experience at InvestEngine, one of the way that we see clients using overnight rate ETFs is for our business accounts. And what these business clients can do is earn interest on the future tax liabilities for VAT and corporation tax, because those taxes are due in installments. So kind of VAT is due quarterly and corporation tax is annual, right? So if you can park that cash that you've got earmarked for paying your future tax liability, future corporation tax, which is due in a year, or future VAT, which is due next quarter, and earn interest on that cash in the meantime, then you're generating a little bit of extra revenue by earning interest on the cash that's due to the taxman, but that you don't have to pay for another kind of several months. So that's one of the popular kind of uses, just anecdotally, for these overnight rate ETFs on the InvestEngine platform. But that's obviously just one use of them. They're super, super flexible and can be used in many different scenarios in a portfolio. So maybe just to finish things off, Haneen, could you elaborate a little bit more on some of the ways that you're seeing investors using these overnight rate ETFs?
Of course. I mean, you highlighted some ways that investors are already using overnight rate ETFs, but I think given everything we've discussed, the competitive yields available and the uncertainty around the UK autumn budget, changing landscapes in the bond and equity market specifically, overnight rate ETFs remain flexible, accessible option and can really help many investors put their money to work again. And there's various ways that you can do this. As you mentioned, one way, I've just listed 6 here, but again, there's different ways that you can use overnight rate ETFs. I mean, one that I've already mentioned earlier on is this whole idea of parking cash. So especially if you're waiting for market clarity, for example, after the budget, or just wanting to keep your options open, then overnight rate ETFs are a great place to temporarily hold your cash instead of leaving cash unproductive. As you saw in your current account, you'll be earning a much less interest. And overnight ETFs earn a very competitive rate with that, and they have that daily compounding as well. And they can also just be a core cash sleeve in general, particularly for those like investors that may be more cautious, want to hold some less risky assets in their portfolio, or if you're like nearing retirement as well, could be one reason for this. And this provides stability and more predictable returns without locking your funds away, as it's easily accessible, as I keep mentioning, and it's as a way to keep liquidity while earning interest with your money. Also mentioned, they can be used within tax efficient accounts. So like they are ISA, you can hold them in your stocks and shares ISA or SIPP. Also used for liquidity management for more institutional professional investors as well are using overnight rate ETFs as you highlighted, not just for your standard savings or your standard portfolio, but like institutional and professional investors are using overnight rates for liquidity and cash management as well. And this is to manage cash with minimal risk, especially useful in uncertain times, making them a practical tool specifically for treasury management. And we're seeing a lot of investors from our side using and have been using overnight rate ETFs, particularly with given the current rates environment. And they are also can be used as a tactical allocation, particularly during rate cycles. So given, as I mentioned, rates are high, then they could be a good way and a good opportunity to access higher yields. And we saw already that they're offering very attractive yields versus gilts and other rates as well, without committing to long duration bonds. So you see that tactical allocation within your portfolio as well. And then more broadly, I think they're a very good diversification tool as well in a multi-asset portfolio, looking to diversify, not put all your eggs in one basket. So adding a low volatility component can help smooth returns and reduce overall risk as well, given where we're seeing some markets are. So in short, overnight rate ETFs aren't just for cash. They are a very versatile tool for stability, liquidity, and tactical opportunities as well. And we see investors use them in many different ways.
Perfect, thank you. That was a really interesting presentation, and based on the number of questions, I can tell it's really resonated with the people that are watching. We are coming towards the end of the webinar. I'm just a little bit conscious of time, so I will do a quick demo to show how to buy this Xtrackers overnight rate ETF on InvestEngine, because I'm aware also we haven't actually shared the ticker yet, so I'll tell you what the ticker is and we can get into that. But in the meantime, do feel free to keep the questions coming. If we don't get a chance to answer them today, then we will do our best to get back to you after the webinar. We always take a log of who's asked which questions, and some of the more popular ones we'll do turn into blog posts and that kind of thing. So tech, if the tech cooperates, I'm going to share my screen. So we've got a nice dummy account to walk through here. Once you're logged into the InvestEngine app, usually most people use the InvestEngine via the app, but obviously for screen sharing reasons, I've got it on my web browser here. I am going to select this nice DIY portfolio. And I'm going to scroll down to this bit here, which is where you can see all the securities in your portfolio. Super simple. I'm going to click Add Securities. And I'm going to click the Xtrackers banner here, which is a super easy way to find all the Xtrackers ETFs on the platform. You can see they've got a really big selection of ETFs on the platform there, many of which we've done webinars on in the past. But today we are talking about the overnight rate ETF. So I'm going to stick overnight in there. Here we go. So this is the one we're looking at today. This is the one we've been talking about, XSTR. This will track the SONIA rate, which Haneen has been talking about. So if we go into this one here, right, we can see, yeah, this line looks very similar to that line that Haneen was talking about in terms of the SONIA rate. So we can see it tracks the SONIA rate really well. You can see all the different the ETF description and what the ETF does, who the issuer is, what the index is, a few stats about the ETF itself. And then if I want to add it to portfolio, I simply click Add to Portfolio there. And you can see in this top right box here that it's been added alongside the other two ETFs that were already in there. So we can just click Continue. And then, okay, what do I want to get rid of? Let's get rid of this one here. And we will put 50%, so everything adds up to 100. I don't want to do complicated maths here. There we go. This is not going to be useful because we don't have any equity in the portfolio now. This is useful for having a look at, if you have an equity portfolio, what your allocations are on your regions, sectors, and your holdings. But we don't have any of that now, so that's target weight updated. There we go. And now we should scroll down and see, here we go. We've now got a 50% target weight here to the XSTR ETF. So if we wanted to actually rebalance into that and take our weight up to 50%, we would go into the options menu and we click rebalance. I'm not going to do it now because it'll break the engine because it's not a real portfolio, but that's how you would do it if you wanted to do that. Or you could, if it's a new account, you simply fund your account for the first time and it would take you up to target weight. Another way to invest, you can set up a savings plan as well. Super simple way to invest regularly, so you can invest a certain amount every month to keep your investments rolling. If you would rather contribute on a regular basis rather than on a kind of a one-off lump sum, but it's as simple as that. And that's this is the ETF that tracks SONIA that we've been talking about today. XSTR is the ticker that you will be looking for. So there we go. It's as easy as that. And I will stop sharing my screen. So let's have a look and see what we've got. Right. Okay. So there are a few simple ones that I can bash out really quickly and easily. I know, Haneen, you did answer this, but in case it's unclear to anybody, XSTR, the Xtrackers overnight rate ETF, it can be held in ISAs and in SIPPs. So that's great. And obviously you don't have to pay tax on any of the gains if you hold them in those vehicles. Somebody was asking how much it costs, which is an important question. And it's 10 basis points. Is that right, Haneen? 10 basis points is 0.1%. There we go. Right. So those are the nice, easy ones out of the way. Okay. Question, which I think we kind of answered in the presentation, but maybe we can just kind of reiterate it again. Someone's asking here, how does this kind of compare to just leaving money in like a high interest savings account or a cash ISA?
Yeah, I mean, I did have that one chart which did explain a little bit about the rates that you can get. So I think there's key difference is with an overnight rate ETF is that you're not faced with any lock-in period. Typically with cash ISAs, to get the higher rate, you're required to at least lock in maybe like a year or two, depending on which ISA you're looking at. Whereas with an overnight rate ETF, you can trade this pretty much every day, and you do not need to lock in your money at all. So it's very flexible and it helps with cash management that way, where you can access it more generally, and it's offering a very competitive yield as well. So in terms of the return, it's pretty much in line. Typically, actually, historically, you look at the rates that you can get from overnight rate versus a 1 year fixed ISA. Typically, SONIA has been higher, and banks tend to pass on interest rate changes much slower to ISAs. But more generally, even if they are in line, as they are currently, you saw on the charts, it's still you're still subject to typically to holding period.
Lovely. Thank you very much. I did see a question come through that I'm trying to find. Oh, yes, here we go. Got it. Somebody who decides to remain anonymous is asking, why should we invest in the overnight rate ETF rather than a fixed income fund or a fixed income ETF?
Yeah, good question. So it depends on which part of fixed income that you're looking at. So I did talk about gilts quite a lot in the presentation. So that's looking at UK government bonds. So looking at that, just simply yields are very attractive when you look at SONIA versus gilts. So you can gain, especially when you're looking at the shorter, medium-term maturities, it is much higher than what you can get in the gilt market. Also, you're not subject to the risk that you would be from holding government bonds. Also, more broadly, if you're looking at fixed income, so if you're looking at credit, you're also not exposed to credit risk, also not exposed to price risk using when you're looking at overnight rate ETFs. You saw the returns always upward sloping, as I explained as well. as long as rates remain positive, your cash will continue to grow and compound on a daily basis. So it's just in terms of the yields are attractive. So number one, and number two is that the risks that you are faced with are very different to when you're holding fixed income, depending on whether you're looking at government bonds or more broadly the credit market as well. So very different exposures.
Perfect. Thank you. Yeah, very comprehensive answer. Somebody here is asking, how does it pay a dividend? And this ETF does pay a dividend. To be clear, please correct me if I'm wrong here, but it does pay a dividend. And I think I was looking at it earlier. It distributes every 6 months. Is that correct?
Yes, around every 6 months.
Yeah, perfect. Okay, thank you. Because you get obviously two types of ETFs, those that accumulate dividends and those that pay dividends. And this is one that does pay dividends. It doesn't wrap them up, it pays them out every 6 months. Right, okay, let's have a look. See. Ah, yes, actually, the first question we got in the whole webinar was, has SONIA replaced LIBOR? What's the difference between the two indices? Because obviously LIBOR, I think, is probably a more household name than SONIA is. So maybe could you provide just a little background on what the difference between SONIA and LIBOR is?
Yeah, so SONIA has replaced LIBOR. I think key difference between the two is in terms of how they're calculated. So as I explained, SONIA is based on actual transactions that happen, so making it quite reliable. If we're looking at LIBOR and what it was in the past, it was based on panel bank submissions, which kind of is lacking the underlying market, while SONIA has a deep liquid underlying, as well as I explained. And LIBOR was more forward-looking as well, versus what SONIA is, which is an overnight rate, so based on actual transactions that have already happened rather than forward-looking. So slightly different in that sense. And LIBOR was also exposed to bank credit risk, while SONIA is a near risk-free rate. So it has become the overnight rate benchmark that's used in the UK and has replaced LIBOR.
Lovely, thank you very much. Okay, let's take this one then. Well, someone's actually asking a very quick one that I can answer. I think someone has asked, is there an accumulation version of this ETF? And I think the answer to that's no, right, Haneen? Is distribution only?
Yeah, I think there's distribution only.
Yeah. But I would say that on InvestEngine, if you do buy the ETF on the InvestEngine platform, you can set up an auto invest feature. So you can set any cash that comes into your portfolio, whether that's through dividends or whether that's through cash that you contribute to the portfolio, it will automatically get invested in line with your target weights. So if you buy XSTR on the platform and set up your auto invest feature with like a minimum cash holding of 0 or maximum cash holding of 0, sorry, then any cash that comes in from the ETF will automatically get reinvested into XSTR for you. And obviously there are no dealing fees. So that's not going to eat into your returns by doing that. So you can kind of create your own accumulation share class if you want to. Right then. Let's have a look. Okay, how quickly do the changes in the Bank of England base rate, or SONIA, I guess as an approximation, feed through to the ETF yield? Is it instant, or how quickly is that transmission mechanism?
It's fairly quickly. So you do see that it's reflected very quickly based on the changes from the base rate. And you can see that as well if you plot the two against each other. So it very much moves in line with the base rate.
Lovely, thank you very much. Somebody's asking that if they're drip feeding into equities over time, is this a good place to hold my money between monthly contributions? And I think you actually had a slide, one of your slides was actually answering that exact question and basically saying that yes, it's a quite a common way for people to hold a kind of cash allocation because it pays you a yield and it makes your cash allocation in your portfolio actually generate you some return rather than just earning you nothing. So yes, I think that's absolutely a valid way to use this ETF as a kind of short-term cash holding while you decide where to allocate to. Right then, let's pick another. Oh my gosh, they're coming thick and fast. This is great. What is the difference between this type of fund, an overnight rate ETF, and a money market fund, which I think is probably more more household names than money market fund. More people tend to know money market funds and overnight rate funds. But could you maybe just highlight some of the key differences between the two?
Of course. So key difference is in terms of so overnight rate ETF essentially is trying to give you exposure to SONIA, which is the overnight rate, which is the near risk-free rate. A money market fund typically provides you slightly higher returns, but it also holds very different instruments in the fund itself. So very different in terms of how they're getting the exposure. So in terms of the risks that you're faced with, so with the overnight rate ETF, because it's synthetic, you're faced with counterparty risk, for example, whereas in a money market funds is typically invested in unsecured securities. So they are faced with that different type of risk there, as well as typically, again, going back to like cash ISAs in terms of a holding period, typically money market funds as well can have some restrictions in terms of how long you need to hold them for. And then another key difference as well is in terms of costs. So ETFs generally tend to be cheaper than other types of funds. So passive funds tend to be cheaper, and that's generally the case as well with money market funds. As you said, this is 10 basis points, so 0.1%. And money market funds tend to be on the more expensive part of the total expense ratio.
Lovely. Thank you very much. Somebody's asking here about kind of how quickly can you get your cash if you are invested in XSTR. So I would say that from InvestEngine's perspective, if you submit your order before 2 p.m. on the day and you click sell, then that will go into that day's trading window and it will settle in 2 days, which is usual for ETFs. All ETFs settle T+2. If you submit your order after 2 p.m., then it will be included in the following day's trading cycle. So in which case it'll be executed the following day and then follow the usual T+2 settlement rules. So no more than 3 days should be the answer to that one. Okay, we've got a couple of minutes left. So I will find one more question before we wrap up, because I think we've probably got time for just one more. And then you're off the hook. Let's have a look. Okay, well, actually, that's probably not a very good last one. There is a question here that's saying, is SONIA a managed portfolio and does it have a management fee? But we've answered that a couple of times and we say, yes, the fee is 10 basis points. Actually, most of these we seem to have answered now. I'm just scrolling up. Can you hold it in ISA? Yes, you can. Can you hold it in a SIPP? Yes. Why should we hold them over gilts? Yeah, fine. Okay, I think we actually might have answered all of the questions here. Oh, actually, no, we've got a couple that we haven't got to. I will actually, this one's not relevant to overnight rate ETF. Someone's asking whether a specific ETF is going to be available on InvestEngine anytime soon, so I won't answer that one. Right. Okay, here we go. I've got one that's just come through. In what situation might the ETF's return diverge from SONIA? What's the kind of risk here? Is there a risk that SONIA changes and the ETF, for whatever reason, doesn't follow through with that change to the SONIA rate? Is there a risk that there's a mismatch between the two rates?
So the overnight rate ETF does have a counterparty risk. I think I mentioned that slightly. So basically, the way that the ETF is basically providing exposure to the SONIA rate is through a synthetic replication. So it aims to track and provide the returns as of the index, so the blue chart that you saw in terms of the returns. So essentially your aim is to get that return. And if there is potential risk that is involved in terms of counterparty risk, then it could diverge, but there typically is aiming to replicate, and most all the ETFs essentially will be providing the returns of the benchmark that they are replicating, usually with a slight tracking error. Potentially, but we don't really see a case where it will diverge and not provide the SONIA rate. But with all investments, there is always going to be some risks. But
Yeah.
you'll typically get what the SONIA rate is and the returns of SONIA.
Perfect. Thank you very much. I think that's a good place to wrap up because we are now 1 minute over. So that is just about all we've got time for. We have got a few questions here that we didn't get around to answering. We will try and get back to you over the next few days. If you're really burning for an answer, you can email support@investengine.com with your question and we will get back to you that way. If you do want to find out more about this ETF, I appreciate my platform demo is a bit of a whiz through, or indeed any of the Xtrackers ETFs that we have on the platform. If you just click that Xtrackers tile at the top of the investments page, you'll find all the details for all the ETFs, including this overnight rate ETF there. Okay, all that's left for me to do then, I guess, is to say thank you, Haneen, for your time today. I think that was a really useful discussion. I'm really pleased at how much engagement we got. Obviously, it's an ETF that people are interested in. Thank you to everybody who's dialed in for joining, and I look forward to seeing everybody on our next webinar.